Hello, this video will cover how to journalize equity-related transactions and determine the effect on the general ledger account balances. And I just have my Excel open. I'm going to go ahead and open up a journal entry template. So if you have a sheet of paper, you can follow along on a paper, or if you prefer, you can also use Excel. And we're going to go ahead and use problem 11-2B, so you can pause the video right now to go get your loose leaf textbook or pull it up through the Connect e-textbook. Alrighty, we're on problem 11-2B, and we have Balthus Corporation reports the following components of the stockholders' equity as of December 31st, 2016. So these are all the balances. You'll notice that we have our paid-in capital, which includes the common stock amount, which is the legal capital, the amount of the stocks that have been issued at par, and you'll see the par value over here. Authorized shares are 320,000, which are the maximum shares this corporation is allowed to issue, and then we have 200,000 shares that are issued and outstanding. Be sure to read the details, so that gives you some inside information. And here goes our excess above the par, the legal capital that we have in common stock. And then we also have our retained earnings, our total over sheet from the basic accounting equation. Next, we will see a list of transactions that occurred during 2017. Now, these balances are the beginning balances for 2017, since they were the ending of the prior year. So the first thing it says, prepare journal entries to record each transaction for 2017. So this is where I'm going to pull up my paper, and I'm going to look at the detail, and my first entry will be January 10th. So I'll go ahead and punch in the correct date, and everyone should know how to do journal entry formats now that we're at the end of the semester. And I'm going to put 2017 there, and then in my general journal, I'm going to put the account to be debited first. So it says purchase 40,000 shares of its own stock at a $12 cash price. So because we purchased back our stock, that means that we, the corporation, are the ones that are making a disbursement. So that means that our cash is going to be credited for the purchase of this item. And what we're going to do is we're going to debit an account called treasury stock. Now, treasury stock, it is an equity account. However, the normal balance of our treasury stock, it will be a debit balance because it's offsetting the equity amount. So this is being deducted against our equity amounts. So now we got to figure out the amount of the debit. We're going to take the 40,000. So we'll go ahead and use the formulas in Excel, since we don't want to take out a calculator when Excel has a built-in calculator. So we're going to take 40,000 shares, multiply it by the cash price per share, which is $12, and we press enter, and we should see $480,000 will be the amount of the debit, and we know our debits must equal our credit, so when we credit cash, it'll be 480. So that's our first entry, and then when we post this information to the general ledger, you'll see here, I can pull it up so you guys can see it better. You'll see right here I have treasury stock. The normal balance for treasury stock is debit. So when we post this, we're going to have 480. And then we will go ahead and post the credit to cash. Now, I don't know what the balance is in cash, and it's really not important for this exercise, but just so you can visually see it. So it's some balance, but again, you're going to put it on the credit side because you're posting. So our next entry, we're going to skip a space, and we're looking at March 2nd. So March 2nd, we're going to go ahead and put in March 2nd, 2017. And on this date, what happened? We have directors declared a $1.50 per share cash dividend payable on March 31st to the March 15 stockholders of record. The dividends will be paid on the outstanding shares. So your question might be, well, how do I get the outstanding shares? Well, from your reading, there is a formula in there. Basically, if you take the outstanding, oh, it's got too many N's. Let me fix that real quick. The outstanding shares will equal the shares issued minus the treasury stock. So that was what 200,000 shares were issued. And then the treasury stock that we just acquired on January 10th was 40,000 shares. So if you take 200 and you subtract the, if you subtract the 40,000, that should give us the 160, the difference between the two. So we're going to pay the dividends on the 160,000 shares, not on the full issued shares of 200,000, because 40,000 are reacquired and back in our treasury. So what I'll do here for my journal entry is I will debit the dividends account. And I believe in this textbook, in terms of this chapter, they actually want you to use the permanent account, which is retained earnings. Because as you all know from closing out your accounts, dividends is a temporary account, and eventually it will be closed to retained earnings. So go ahead and just debit the retained earnings, but I'm going to go ahead and include both accounts so you can make sure you understand where it would initially go. And then I'm going to take the $1.50, which I get from the problem, $1.50 per share, and so that's 1.5, and I'm going to multiply that by my calculation of 160,000 shares, and I get $240,000 for the dividend. And let's see, because it is not going to be paid until what date? It is payable on the 31st. We're going to go ahead and recognize the credit as a dividends payable. Okay. And I forgot to put my little cross-reference. We're not officially doing the posting in proper terms right now. We're just going through and focusing on the journal entries. So we got dividends, 240 dividends payable, and then it asks for the next date, which is March 31st. You'll notice it does not use March 15th, the date of record, and make sure you read in the textbook the difference between these three dates, but there's no journal entry on the date of record. And we're going to go ahead and do the date of payment. So this is when you pay the cash, and that'll be March 31st. And then we have our dividends payable will be our debit, and then cash will be our credit. And again, it'll be the amount that we previously declared earlier in the month. Okay. So now we're ready to do the next entry. After March 31st, we have November 11th. So we're going to use that date, November 11th. Now what happened on this date? It said we sold 24,000 of the 40,000 shares. So we sold them back. We reacquired them. They're in the treasury right now at $12 a piece, but this time we're selling it back at a price higher than what we paid. So we paid $12, now we're selling it back for $13. Now because we're selling it, that means we're going to receive cash. So we're going to debit cash for the, let's see, 24,000 times the 13. So we're going to sell it for $312, and then we are going to credit our contra equity account, treasury stock. Now we got to remember what we originally paid for, what's recorded in the general ledger account, and that was, let's see, $12. And we're going to multiply that by the 24,000 shares. And so you'll notice here that we get 288,000, and I'm going to see if I can pull it up some. So if the treasury stock will be credited at 288, the difference will be the $1 excess times the 24,000 shares, and that'll be 24,000. When you add up those two credits, it should reconcile to the debit, and the account we're going to credit will be paid in capital from treasury stock. Okay. And you'll notice over here that paid-in capital from treasury stock has a normal balance of credit, whereas the treasury stock has a normal balance of debit. Now, I didn't do my postings, but if we want to go ahead and do catch up on our postings, and I'll pretend like I posted to the dividends payable and so forth, because I don't have all the accounts listed. But let's see, 40. And for the treasury stock, again, it's going to be 288, 1, 2, 3, and then 24 credit on here. And we're ready to move on to the next one. Next one will be November 25th, sold 16,000 of his treasury stock, shares at $9.50. So 2 weeks later, the price dropped substantially. And keep in mind, we start off with 40, we sold 24, so that means we actually had 16 left. So what we'll do here is we'll go ahead and do the 11/25 date will be what we use. And I'm going to scroll it down a little bit. And on this date, we're going to get cash. And so that you can see what our problem says, we're going to take the $9.50 and then multiply that by the $16,000. And, oh, that's how much cash we're going to get. But keep in mind that the treasury stock originally cost us $12. So we're going to have to take the $16,000 and then we're going to multiply it by the cost that we originally purchased it at. And then you'll see that 192 and 152, so we're out of balance. And in this case, because the price dropped, we are basically short money. And so now we got to figure out where to put it. So because we are short money, we're going to go ahead and debit an account. And the account that we're going to debit is going to be based on what's already in the balance for the paid-in capital from treasury. And let's see, I think I have something. Oh, I put too many when I did the posting. It should have been 24,000. So that was 24,000. I put too many zeros, so make sure you fix that on your paper. 24,000, and then we have a shortage. So now we got to figure out where this 40,000 is coming from. Now because we have 24 in here, we're going to first use the balance that's in the paid-in from treasury. So we'll do paid-in capital from treasury stock. And then the difference, we still need some more. We need actually, what, 16,000 more to cover the difference. And that 16,000, because we will have exhausted this balance, has to come from our retained earnings. We can't take it from our regular paid-in capital in excess of par because it's related to a different item, our common stock account. So we'll go ahead and debit retained earnings for the 16,000. And then when we go in, and let's go ahead and, I don't know, fictitious count to cross-reference. And then when we do our cash, what, 152. So now we look at our cash, don't worry about that. But our treasury stock now is back at zero balance once we've sold all of our previously purchased 40,000 treasury stock. And then you'll notice that the paid-in capital from treasury stock is at zero as well. And then we went ahead and posted the credit to the retained earnings to reduce it to make up for that shortfall because the price fell well below the $12.